Okay, we're just gonna leave it where it's at. I kind of like that, even though it is a little. Okay, I'm not gonna look at that. I'm not gonna look at that too closely because you can fix it after. Okay, you see, this is day 3 of our 30-day content. We're into it. Y'all thought I wasn't gonna be able to keep up, but I can keep up because I'm me. Okay, but what I will say is the last videos have been too long. I'm supposed to be limiting myself to 8 to 10 minutes, and I've been speaking for like over an hour and cutting it down to 30 minutes, and that's not good because you can't do that every day. So we're gonna get right into it. Today's video is gonna be a quick discussion. I think today's video, I say a quick discussion, but I can already see myself talking about it for like 2 hours. Today's video is gonna be a quick discussion on debt. And it's going to be a separate discussion from our credit conversation that we had yesterday. But today we're going to focus mainly on the question of debt and how much debt do you need or can you have to buy a house. So we're going to get into it. One of the most common questions that I get is, can I buy a house if I have debt or student loans? And I think that's actually a really good question to ask if you're a first-time buyer and you don't know where you lead with things. The reason that I say that is, I think that the answer is yes. You can buy a house with student loans. You can buy a house with debt. Not all types of debt, not a massive amount, but if you have some debt, you can typically still buy a house with a little bit of debt. There are people buying homes every single day with card payments, credit card payments, student loans, even significant student loans, 6-figure student loans. People buy homes every day. It happens. But if you just say yes, the answer is incomplete. Because yes, people do buy homes with loans, and it's loans and debt that they have and they have had. But there are some stipulations, because the real question is not whether or not you have debt, it's how your debt is being calculated in connection or correlation to your income, and then how that's being perceived by a lender. And that is the difference between an approval or a denial. See, that's what a lot of people don't consider, because if you don't actually pay attention, it's not just how much debt you have, it's not even your debt to income ratio, but it's also about how your lender perceives those equations in their risk assessment. So there's a lot of things going on, but that's why it's so confusing. You see me look over here a lot today. I am today and tomorrow going to be doing training from 8 a.m. to 5 a.m. for real estate. So it's a lot going on, but that's why these videos are going to be shorter. And I'm also doing the training live, but right now we just in the beginning. They just do an introduction, talk about realtor stuff. I already know that we got a whole bunch of realtors. I want to get to the good stuff. I want to learn how to juice it for leads. That's what I really want. So once I get to that, that's when I'm going to clock in. But yeah, people don't give you the full answers. And this is what I'm talking about when I say we're already at 5 minutes and I barely got into the introduction. Okay. So when you apply for a mortgage, lenders are evaluating your debt, but they're not evaluating it emotionally. They're evaluating your numbers specifically. Who's this? So when you apply for a mortgage, lenders are evaluating your debt and your income, but they're not evaluating it emotionally. What they are evaluating are your numbers. And to be frank, they're not even looking at everything. They don't care that you didn't pay off your Comcast bill back in 2018 and now you owe them $175. But what they do care about is a specific number called the debt to income ratio. This is a very important equation that you all should pay attention to. If you want to buy a house, your debt to income is the most important number that you must consider. There are a whole bunch of other factors to consider. You need to consider your income, you need to consider your overall debt, your credit score, your credit profile. There are a bunch of things to consider, but this is what's gonna decide whether or not you get approved or denied, how much you will qualify for, and how much you can afford. This is all things wrapped into one, your debt to income. Your debt to income ratio is, simply put, just the percentage of your monthly income that goes towards paying your debts, including your future housing payment. If your obligations are too high relative to your income, you will not qualify, regardless of how responsible you've been. So Let me go over to the whiteboard and show you how this works exactly. But let me tell you, you have to pay attention to the fact that your debt to income is the most important ratio when you are getting pre-approved and deciding what you will and will not be able to afford in the future. Write it down. This is not, don't even save it and bookmark this. I'm gonna watch this later. No. Pull out a notebook, pull out a pen, and write down debt to income equals. And we're gonna go to the whiteboard and talk it out. Pay attention to the whiteboard. Okay, so let's say your income, let's say you earn $6,000 a month before taxes. $6,000 per month, that's how much you earn. Now let's say your existing debts total around $500 per month. If we add a projected mortgage payment of $2,000, your total monthly obligations just went from $500 to $2,500. Do you get that? Did you stay with me? So let's say you owe Comcast $100 per month. Let's say you owe T-Mobile, because for some reason you don't get the equal. So let's say you got Comcast 100, T-Mobile, you're not merging your internet with your phone, so now you got two bills for $100 instead of one bill for $150 because you're not doing the smart stuff. And then let's say you owe somebody else, damn. Who else would you owe? What other things people pay for? But let's say you owe student loans. Too low. $300 a month. These are all per month. Now your monthly obligations are $500 per month. And then let's say you want to go get a mortgage. They say fine, you can get a mortgage, but your minimum monthly payment is going to be $2,000 per month for the house you want. You just went from $500 to $2,500 per month. Now let's say most mortgage loan brokers require 40% min DTI. If you do the math on that, look, hold on, let me pull up my calculator because I don't do math readily on the I don't do math readily. If you do the math on that, they want a 40% min 25. This is gonna equal 41.6% DTI. I'm out of breath. I don't like doing all that type of math. If I'm doing math like that, you owe me a commission. You owe me a commission. Stop. If I do math like that, you owe me a commission. So that puts your total monthly DTI at roughly around 41%, which is generally within an acceptable range. So again, this is not an issue of how much debt you have or whether you can qualify, because the answer right here is they want a min 40, you got 41. Wait. Well, let's say let's say this is 45%. Y'all didn't even correct me. Y'all, damn. This is why I be filming for 2 hours. Damn. Okay. So now you fall within the guidelines that we just made up in our head, but this is how banks do it. So they just make this shit up in their head anyway. It's fine. You fine. You get it. I get it. We get it. We good. Okay. I don't even know where I was at. I'm lost. I done got myself lost talking about this. Do you see the thing though? If you, do you see the thing though? If you got the debts and the income and the you make it. But look, okay, let me stop. I know what I'm doing. I know what I'm talking about. If you fall within their income thresholds and you're making enough to offset what you owe monthly, you can actually qualify for the loan. The problem that we fall into is there's a 4.4%. Like, you have very little leeway. You could either put a lot more down, which is where student loans actually create confusion. Because I was just talking shit. This isn't confusing. This is actually the easiest part. This is how you know what your DTI is. Once you figure out what your DTI is, you can go reverse search engineering any bank and find out what DTI they're looking for, and you can figure out where you actually would have qualified for before you even go to your pre-approval. This is very important, and you should all know this. This is one of the most important things if you're ready to buy a home. Now, more importantly, this is where student loans create confusion because they're not all treated the same across all loan types. If you have a student loan, oh, I don't have mine. Is debt or my student loans gonna be the thing that stops me from buying a home? My honest answer isn't no or yes. My honest answer is the debt itself is not the issue. What typically prevents people from buying a home is a combination of monthly obligations like student loans, credit cards, car loans, relative to your monthly amount of income. In some cases, it's just a matter of adjusting your expectations. And in others, it might be a matter of raising your income or eliminating your debt. You have to choose and identify what's the most accessible, responsible, and attainable goal that you can chase for and strive for. But the key is understanding your numbers. And once you understand your numbers, you can do almost anything. So yes, you can buy a house with debt. And yes, you can buy a house with student loans. Also, no, you might not be able to buy a house with debt. And no, you might not be able to buy a house with student loans. But the outcome depends entirely on you and how you manage your own situation. How your debt is being calculated is just a matter of perception, and you have to get control over what debt you have, what your income is, and how you can structure that image in front of a lender to set yourself up for success. And that's where a real estate agent comes in. Because once you understand that segment and the math and the internal equation, you can move forward without guessing and actually be in control of the process. And something that people don't understand is when you're understanding the process and you're in control and you can actually use these different knowledge points as points of leverage, you could actually shop around for different mortgages and you can go to a different company or a different brokerage and you can see what they offer and what they don't offer. So it's a matter of being a diligent servant of your own resources. And I think that's really the point. The clarity is the leverage. And that's the theme for this week's course, is understanding that you really have to put into perspective your own ability to manage your situation. And once you do that, you start looking more responsible. Then you could go to Carrington Mortgage, Guild Mortgage, First American, and you could understand that what they're looking at is debt to income ratio, and what they're giving you is their best risk assessment. So now you could shop around and you say, well, Carrington, they said that what I have going on in my profile sets me up for this type of interest rate, but you're saying this. Are you able to match it? Are you able to come down on your terms? How can we work this out so I'm in a better financial position because I want to choose you? And now you're in a position where you could actually negotiate from a better standpoint with better offers and go into things with clarity. And clarity is leverage. Don't ever forget that. That's the end of today's video. I cannot keep going because I could talk about this for hours. But debt to income ratio is the most important critical thing that I want everybody to always consider every day. If you're buying a home,